I'm one of the few public sector creative industry fund managers in the UK. I manage a regional fund of £2.4 million based in Newcastle and focused on commercial creative companies from the northeast region of England. Much has been written over the last 5 years about the needs and support for growing commercially creative businesses. Initially, there was talk about the funding gap. There was no investment finance between £250,000 and £2 million. Then we moved on to acknowledge that it probably wasn't about money, it was about the creative industries operating in a slightly different way. Then there was a move away from this notion of exceptionalism and towards the fact that businesses were not investment ready. I'm sure the conversation will move on to the fact that the public sector do not have the skills to be investors, and at this level they are therefore alienating private investment. I think to date that the public sector has a clear perception as to why it should be operating in the investment field, and I think it probably falls into three areas. Identification and development of talent, the regeneration of particular areas and regions through jobs created, jobs secured, businesses supported, and the attraction of inward investment. What also should be in here is commercial return. And I think for all the funds and fund organisers, they would claim that there is a requirement for commercial return. However, there are considerable restrictions to the way that public sector investment finance can be used. And these have an impact on the amount of return and when it can be expected. All public sector investment finance are governed by state aid regulations, which in themselves have created an industry for those who understand the finer points of accountancy and law. However, in a nutshell, it restricts investments up to €200,000, which in the UK now means about £150,000. There are exceptions to this rule, and if you have a year of your life to spare, you can get notification from the EU to go above this level. Or you can invest on an equal basis with a private individual or institution. Public sector finance within the creative industries is not just limited by state aid rules. There are also other procedural limitations. Most public sector early stage funds sidesteps the question of valuation of pre-revenue companies, preferring to use a convertible loan as an initial form of investment. And this gives the fund the right to convert at the same proportionate rate as a next round of private investors. This means that in general, all public sector investment finance is immediately on the hunt for more money. It is possible to work with other co-investment funds or private finance to put together an initial investment of say about £300,000 as equity and £50,000 as convertible loan. So my fund operates in the region between £60,000 and £350,000 or €440,000, which is pretty decent money for a first round. At this higher level, we'd be expecting a return within 3 to 5 years. At the state aid level, or lower level, we would be expecting a return in 5 to 7 years, depending on the success of further rounds of finance. And what this level of return should be is difficult to estimate because none of the UK public sector investment funds focused on creative industries has actually been operating long enough to have developed a returns profile. We're also very unlikely to follow on with further investment rounds. We're also unlikely to be bought out during the second round, as the company is still making, probably at this stage, small returns. And therefore we are at risk, at quite a high risk, of having our equity stake diluted. My fund, as a rule of thumb, does not get involved in the development of new technology. There's science and technology funds, and plenty of them that do that. The fund works with emerged or existing technologies, and we're therefore investing in creative services businesses with the particular challenges they face around scalability, creative content businesses where the ambition of the company to service a particular market must be reflected in the resources required to service the customer needs. And this combination of limited capital injection, lengthy gestation periods before returns are started, limited options for following the winners, and high-risk profiles due to the particular factors within the business models indicates that there are restrictions to the natural way commercial return should accrue to an investor. In my view, a public sector investment fund operating under state aid rules within the commercial creative sector should be part of a considered system for the development of investment-ready businesses, rather than being set up as a separate financing operation. The UK government has made a commitment in recent strategy document Creative Britain to helping creative businesses grow and access finance. This will be delivered through the new Business Support Development Programme as an investment readiness initiative. The European Council defined investment readiness as follows: the capacity of an SME or entrepreneur who is looking for external finance, in particular equity finance, to understand the specific needs of an investor. And I think that's really important, understand the specific needs of an investor, and to be able to respond to these needs by providing an appropriate structure, relevant information, by being credible, and by creating confidence. Currently, investment readiness programs are sporadic and inconsistent. There seem to me a variety of activities which shouldn't make up the investment readiness provision. First of all, defining the companies with investment potential. Secondly, something that I call chalk and talk, by which I mean the classroom approach, where you're taught about investment and the specific needs of an investor, and there's plenty of activity in this area. Thirdly, grooming, where you work with mentors to ensure that the company and the management team is in the best shape in terms of structure, information and valuations. And finally, networks and experience. This is particularly difficult and requires trust and commitment and an intensive working environment, such as something called Seed Camp, which currently is a technology startup hothouse. With the exception of Seed Camp, where there is access to limited finance, at no point is a public sector investment fund seen as being part of the system of investment readiness. It is usually seen as the destination. However, public investment finance is not the equivalent of raising private sector finance. Due diligence is limited, legals are not onerous, valuation is avoided, return is required but not defined, and therefore the fund should be seen as part of the investment readiness programme. What the public sector can then bring to the table for those seeking further investment is the rigour that is required when reporting to external partners, the requirement for attaining performance targets and performance management, the development of real value, real commercial value, measurable value, value that stays within the company even when the owners exit, and that value which will then attract further investment. This walking the talk by truly understanding the specific needs of an investor and responding to those needs by providing an appropriate structure, relevant information, therefore being credible and creating confidence, is critical to attracting further finance. I would like to find out from private investors whether this approach to investment readiness is one that they can embrace, and from those working in the business support arena, whether there are any conversations or examples of initiatives that bring together these disparate approaches into a concerted system.